Hello everyone and welcome to the Money Pros. I'm Oliver Tutt. I'm a practicing financial planner and I'm going to be your host for the next half hour as we talk about the issues related to your money, how to make it, how to keep it, and hopefully how to help it grow. We've got a lot to get to today on our agenda. We're going to be talking about a great option for investing in your 401k plan, particularly for those of you that really don't want to pay any attention to your 401k plan at all. So we're going to talk a little bit about that. We've got our mortgage pro with us. He's Steve Tetzner, Vice President of Homestar Mortgage. We're going to be talking about how do you choose the right loan if you're in a situation where you need to borrow, whether it's a refinance or a purchase. What are some of the things you need to consider to get the right loan for your situation? Also, can you predict the stock market by the Super Bowl winner or perhaps by the length of a woman's hemline? Well, we're going to have the answer for you in a later segment. I think you're going to think the information is at least entertaining, if not actually useful. And then finally, President Obama's recent financial disclosure came out. So we're going to take a look at how the president's financials appear. And I might have a couple of pieces of advice for President Obama in his financial planning if this financial disclosure is at all accurate. But first up, a great option for investing in your 401k. Target date funds are a new and increasingly popular investment option that is available principally in 401k and other retirement plans, although you can buy them on a retail basis through brokerage platforms. According to the Morningstar database, 2,150 target date funds currently exist, and that's come up from almost nothing as little as 5 or 8 years ago as they've exploded in popularity. This represents $600 billion in assets, so they've certainly become a very popular option for many. And they're a great option for those of you that don't want to sit down and take the time to develop your own asset allocations. The reality is that when 401ks came out 20 years ago or so now, and they've really exploded in popularity among employers, we really did a disservice to individual investors because all of a sudden we took them from a situation where they had a pension plan and their employer and professionals took care of the investing of the funds. We put them in a situation where they had to become their own investment managers. And for years, people were responsible for picking their own mutual funds, picking their own asset allocations, and making smart decisions about their money. Target date funds are really the answer to that for those people that don't want to go through the effort to make those decisions and perhaps don't have the time or the knowledge. So let's take a look at some of the pros and cons of target date funds. First, the pros. The big advantage is it's an all-in-one portfolio, a target date fund, and you choose a target date fund based on your approximate year that you're going to retire. Most of them work off the approximate year that you're going to turn 65, generally within 2 or 3 years of that date. And it's an all-in-one portfolio. Usually that one fund is a combination of other funds put together in a mix that makes sense based on the time horizon that you have. Second, it's a professional asset allocation. So rather than you trying to cobble together, whether it be through websites or reading articles or following the stars, trying to figure out what exactly your asset allocation should be, you have a professional that's designed the asset allocation based on the date of your expected retirement. Next, automatic account rebalancing. Now, we've talked about on the show many times the importance of rebalancing your portfolio on a regular basis to maintain the set of the set allocation that you've decided on. This instills the discipline you need if you are not disciplined enough to go in and rebalance the account on your own. And finally, you'll find that target date funds are pretty cost competitive. Now, some can be more expensive than others, but the industry has generally done a pretty good job of driving down the costs, and most don't have additional costs on top of the expenses for the underlying funds. Now, target date funds do have some disadvantages that you need to be aware of and you need to consider if you're thinking about incorporating them into your investing in your 401k. First is you have complete lack of control. So if you're a do-it-yourselfer that wants to be able to control the mix of stocks and bonds you have, particularly if you want to be able to control it from year to year or month to month, which candidly I advise against, you're better to set it and forget it. But if that's the kind of control you want, you're not going to get it in a target date fund. It's really going to be done for you. Next, it's really hard to incorporate target date funds with other investment strategies. I will say as an investment professional, when I'm managing someone's portfolio and they have a target date fund held outside of that portfolio, it becomes a little cumbersome to integrate the two because the target date fund doesn't represent just one investment. It represents a host of investments, and it's not always transparent exactly what it is. And finally, they may become overly conservative as you get toward retirement. The asset allocation is going to change as you get older. So as you approach that retirement date, your allocation in that target date fund is going to go from more stocks to more bonds. And that may not be the right decision depending on your particular financial circumstance or exactly what you, when you want to retire. That's a little bit about target date funds. If it's something of interest to you, I would suggest you check out with your plan custodian to see if they are available. And when we come back, we're going to have our special guest, Steve Tetzner, Vice President of Homestar Mortgage, on how to choose the right loan for your situation. So stay with us. There's more to come here on The Money Pros. Welcome back to The Money Pros. I'm joined now by our Mortgage Money Pro, Vice President of Homestar Mortgage, Steve Tetzner. Steve, you'd think I'd have your intro down by now, as long as you've been with us.
It's only been a few years.
It's only because I'm so excited about the topic we're going to talk about. I think, in all the times we've had you on, we've talked about a lot of different products, programs, and things like that. Mm-hmm. But I have to think at the heart of what you do on a daily basis is ultimately helping people try to figure out what's the right loan for their situation. Right. And I think this is something I struggle to counsel people on as a financial planner, and I generally contact you and say, what do we do in this situation? Right. But let's see if we can sort of break through some of the decisions that people have to make so they can kind of make some right choices in the various forks in the road as they decide.
Sure.
So we have purchasing and we have refinancing, but when we're talking about, it would apply to both, but generally when you're purchasing, among the big decisions you have to make is a general decision about, am I going to go with a fixed rate loan? And of course you have a variety of terms you can go with, or am I going to go with an adjustable rate loan?
Right.
I think a lot of people have set in their head that one is better than another. That's not necessarily true. If you're being open-minded about it, what's the best way to go about making that initial decision about fixed versus adjustable?
Well, first let me say, Oliver, when a lot of people hear the word adjustable, they immediately get scared. And what they don't understand is that many adjustables are what we call delayed adjustable rate mortgages, 5-1, 7-1, 10-1, and now even a product called a 15-1 ARM. The first number in the ARM represents the number of years that the interest rate would be fixed, and then it would become an adjustable rate mortgage. So the first question I always ask a person is, well, what is your intention with this property? How long do you actually think you're going to live here? And when you have a lot of first-time home buyers, many of the people tend to move up from a property in 5 to 7 years.
Yeah, as I did, yep.
Yep, maybe 8 or 9 years, and their intent is, well, we're going to sell that property, roll that equity over to the new home. So for a lot of first-time home buyers, believe it or not, a 7-1 ARM can be a very, very attractive product, as opposed to a standard 30-year fixed. A 30-year fixed right now, the interest rate would be around 4.125%, as opposed to a 7-1 ARM, the interest rate could be as low as maybe 3.125%. So you're talking about almost a full percentage point difference in the interest that you're paying over the 5 or 6 years that you're going to live in that property. If you're not going to be there more than 7 years, what do you care what happens with the mortgage after 7 years?
Well, and that brings me to my next question. And then so my next question is, does it make sense with respect to lowering rates to pay points on a mortgage? But along with that, do you find that people are sort of hung up with, it's almost like what's the rate on your mortgage has become a conversation at a cocktail party. I mean,
right.
So it gets to that question of, should I pay points to drive down on the rate on my mortgage so I have a lower rate to brag about? I mean, what's your advice on points? And then do you find that it's almost like a competitive, like your golf handicap, what your mortgage rate is?
For me, every person I get introduced to tells me what the rate is on their mortgage.
It's like being a doctor, and I got a pain right
Right,
there.
exactly. I think that the rate on the mortgage really also depends, because you have to realize too that whether the longer the term of the loan that you have, in the market that you took the loan out, the higher the interest rate. So a 30-year mortgage rate right now would be around 4.125. A 15-year mortgage rate would be around 3.125. So it's the term of the loan, the amortization time, also determines the interest rate that you can get on the loan. And that's also another question as opposed to adjustable or fixed that I work with folks, especially when they're talking about, when they want to retire, when do they want to have the house paid off, and then the question, of course, of how much can they comfortably pay each month? Obviously, the shorter the term the loan that you can do as far as the amortization, not only do you get the benefit of a lower interest rate, but you're paying substantially more principal each month on the loan, which means you're paying that loan off faster, and over the life of the loan, a 30 versus a 15-year, you're talking about tens of thousands of dollars difference in interest on the loan.
And you really have to weigh that, but even if you can't afford it, because obviously affording it is sort of the first milestone. And
Yes.
if you can't afford it, you're not going to do the shorter loan.
Absolutely.
But if you can afford it, you then still have to weigh it versus what that cash flow might otherwise be doing. If it's going to be going to just funding, you know, vacations and things that you might not otherwise need, then amortizing that loan would really be a better option. But if there's other investment opportunities, you have to weigh that in comparison.
You do,
right?
you do. But I mean, it is a substantial amount, you know, in the
And it's
interest
hard
rate.
money,
Right.
It's a sure thing, essentially.
Exactly. Yeah.
So here's another question I have for you, and this was one that kind of came as a surprise when I bought my first house, you know, 20 years ago or whatever. But there's a lot of special programs out there. People are thinking that, you know, gee, I got to put 20% down and I'm going to get this kind of conventional mortgage. But in reality, for a lot of different, you know, classes of people, for lack of a better expression, there are special programs that are available that might lower interest rates, lower down payments, reduce or eliminate costs. How do I figure out if I'm eligible for a program that I might not even be aware exists?
That's a great question. I mean, one of the things you can do is we're obviously work with a mortgage person with a company that offers the diverse product mix, because then they're going to be able to guide you into the best product. You may have to talk to a couple people at a couple different lending institutions to get different opinions. But you're absolutely right. There are USDA loans that are available based on income limits and where the property is located, which can be low and no down payment loans with very low private mortgage. Well, it's not called private mortgage insurance, but low mortgage insurance premiums. You have a VA loan that's available for veterans, FHA loans. There are special first-time homebuyer loans that are available. Now there are products that are available in the market now that also allow for a 5 or 10 or 15% down payment, where you could actually pay a slightly higher interest rate on the loan but not pay private mortgage insurance. So there's a lot of options. So what I like to do is sit down with a client when they've found the property they've identified, look at the purchase price, what their availability is for their cash for the down payment, and then examine the different loan options, but different amortizations, fixed versus adjustable, pay PMI, don't pay PMI.
Right.
Is there a special product that they qualify for, like the VA or the USDA?
So I'm curious what you just said. You said, you know, I like to sit down with a client once they found the property that they want to buy. But would it potentially make sense to seek out my mortgage broker even before I've identified the individual property? Because if they're, I sort of need to know what I can qualify for, what I can really afford, particularly if there are programs out there that might make a property more affordable before I even start shopping, right?
That's correct. Well, you have to get pre-approved or pre-qualified. So you have to make sure that you can obtain financing, get a general idea of what programs you're going to look at when the time comes. But I like to wait until they actually have a property, because sometimes it takes people 6 months or 9 months to find a property. You can't make a decision on what loan you're going to do today if you're going to buy a property 6 months from now, because the interest rates could be different, the program availability could be different, your financial situation may be different, income, credit score. So you need to make that final decision and do the actual spreadsheets when you've identified the property.
All right, let's talk cost, because I think this is something that a lot of people struggle with, is simply the comparison of one loan to another. Sometimes clients get in a situation where they're working with more than one mortgage broker for whatever reason, or they're shopping around on their own thinking they're being informed consumers, and potentially they're being misled or swayed by numbers that aren't particularly relevant. When it comes right down to it, what's the best way for a consumer to compare the cost? Let's say they've decided on a loan, so at least we're comparing apples to apples. What's the best way to compare costs so they make an informed decision about the right loan to go to?
You should ask your lender for what's called a good faith estimate. The estimate provided now under federal law has those fees that are disclosed to the borrower have to be honored for 10 days after the disclosure is provided, even if the borrower doesn't apply the day the good faith estimate is provided. The interest rate may change, but the fees that you quote are supposed to be guaranteed. When you look at that breakdown, it can be a little deceiving. What people need to realize is if you're comparing one lender to another, it's really the interest rate and the fees that lender is directly charging you. Your legal fees, your title insurance fees, your fees to record the documents, those are your closing costs. Those are going to be the same whether you get the loan from lender A or lender B. It's the fees that lender charges. What are they charging you to process, underwrite, tax service, flood cert, the fees that the lender is responsible for?
Do you find that those fees can differ dramatically, like between borrowers, or?
Well, between programs they can.
Is there the potential for a borrower to be taken advantage of, let's say, or to pay more than they really needed to because they weren't diligent about shopping around?
I think that most consumers I see today are educated consumers. I think that there's still a small percentage maybe that don't do their due diligence. They're just happy that they can get a loan, and they don't bother to ask if they could get a better rate or a better plan from another, another lender. Every lender has different interest rates and different fees. So I always recommend to people, even people that I'm working with, take my interest rate and go compare it to another person and see, or another lender, and see how I compare. Usually we're about the lowest in the market, so I know that, I want my customer to feel comfortable that the deal that I'm giving them is a legitimate deal.
So there's obviously a lot of choices that you face when you're trying to choose the right loan, but the bottom line, I think, is to consider the total cost, consider how long you're going to be in the property.
Right.
I think even more bottom line than that, perhaps, is you got to work with a broker who really knows what's available, knows what's out there, and doesn't have their hands tied.
Well, and also make sure that they're looking at all the aspect of the underwriting guidelines of that product that they're putting you into to make sure you absolutely qualify for that loan program. More times than not, that's the problem I see, is that a loan officer will miss an obscure guideline, the borrower doesn't quite meet the guideline of the program, and they end up getting denied.
All right, great advice as always, Steve. Thank you very much. All right, when we come back, can you predict the stock market by who won the Super Bowl or the length of a woman's hemline? Well, we're going to tell you the real answer. That's coming up and more here on The Money Pros, so stay tuned. Welcome back to The Money Pros. So we're all searching for that holy grail of investing, which is some crystal ball that tells us when the market's going to go up and when the market's going to go down. If we had that, it would be great, right? We'd get all the gains and none of the losses. And I would be the first one to admit that if that was available, I'd be all over it. In fact, I wouldn't be working for a living. I'd just be doing that. But let's talk about some of the more oddball ways to predict which direction the stock market is heading. So here's some I dug up unusual stock market indicators that have a high degree of correlation with the direction of the stock market. The first is if one of the original 8 NFL teams wins the Super Bowl. And I can't recite each and every one of them, but the original NFL teams, if they win the Super Bowl, there's a very high degree of correlation with the stock market actually increasing that year. Does that mean that what team wins the Super Bowl predicts which direction the stock market's going? Let's put up the other one. Next, the skirt length theory. The theory being that as women's hemlines rise or fall on the length of their skirts, the higher they go, the better the stock market is going to do. The lower they go, the worse the stock market is going to do. If my kids' hemlines on their skirts that they wear to school is any indication, we're in for a continued bull market, although it'll be a bear market if I have anything to say about it. However, there's definitely a correlation between hemlines and the stock market. Does that mean anything? Here are a couple others for you. Butter production in Bangladesh, India. When butter production in Bangladesh goes up, the stock market does well. When butter production in Bangladesh goes down, the stock market does poorly. How many of the folks in the Money Pros audience are following butter production in Bangladesh, India? And finally, presidential approval ratings. This is an inverse correlation. There is a strong inverse correlation. The better presidential approval ratings are, the worse for the stock market. The worse presidential approval ratings are, the better for the stock market. If that's an indicator, given where Obama's approval ratings are right now might be a great time to invest. The question is, are any of these things really predictive of which way the stock market is going? And my answer to you is, unfortunately not. If you believe that any of those are indicators, you're making a classic statistical mistake, and that's confusing correlation with causation. Just because two series of data have a high correlation with each other does not mean that one causes the other. Let me give you some examples. We'll put up another slide. These examples are courtesy of a website called spuriouscorrelations.com, meaning examples of correlations that mean absolutely nothing. So, Eric, do we have that slide? Oh, we don't have that slide, so I'm going to lay it on you. Actually, my apologies, I don't think we actually have a slide, but I'm going to lay them on you anyway. First one is the divorce rate in Maine is highly correlated to U.S. margarine consumption. Consumption of mozzarella cheese is highly correlated to the number of civil engineering PhDs that graduate in the United States. Next, deaths due to bedsheet tangling. They actually track this statistic. Deaths due to bedsheet tangling is highly correlated with U.S. ski resort revenue. And finally, drowning by falling out of a fishing boat is highly correlated with marriages in Kentucky. There may actually be some causation there. We haven't actually determined that. But the point being, just because two things are correlated with each other does not mean that one thing causes the other. So don't make the mistake of investing your portfolio based on who won the Super Bowl or where the length of a skirt is in the closet. So there's a little investment advice. All right, up next, we're going to take a look at President Obama's financial disclosure statement. Maybe we'll have some financial planning advice for him. So stay tuned. We've still got more to come here on the Money Pros. Welcome back to the Money Pros. President Obama's financial disclosure statement was recently released, and I thought it might be interesting to take a look at some of the numbers, and we'll talk about some financial planning advice potentially that the president may or may not want. I know he's got plenty of advisors at his disposal, but why shouldn't I join my voice to the chorus? So according to his recent financial disclosure, which presidents and vice presidents and other elected officials are required to file, he listed between $1.95 and $7.5 million of investable assets, in which he indicated that between $1 and $5 million were invested in treasuries. Now, in my experience, a man of his age, with a distance to go to retirement of, depending on how you look at it, either a couple of years or many, many years, probably is overly invested in treasuries. Now, we all know he's probably required to either have a blind trust or to invest his money in treasuries, so it's not particularly surprising. But if he was anybody else, we probably wouldn't want that much in fixed income. He's got a $400,000 salary, and he had an outside income of between $180,000 and $482,000 from book royalties and investments, which is extremely healthy. I think it's important that you diversify your income. If you can get income from beyond salary, that's excellent. And he indicates that he has a 30-year mortgage of between $500,000 and $1 million at a rate of 5.625%. Now, I think our mortgage pro, Steve Tetzner, who joined us earlier, would be the first one to say that he needs to get that mortgage refinanced because 5.625 on a 30-year is really too much, but he is living rent-free in the White House. All right, do you have a question for us at the Money Pros? You have a suggestion or a comment that you want to share with us? Reach out to us. Visit the Money Pros Facebook page by searching for the Money Pros. You can tweet at us at the Money Pros, and you can also send us an email, moneypros@foxprovidence.com. We want your questions, your comments, your ideas for future stories. So that's it for today's edition of the Money Pros. We look forward to seeing you again back here next Sunday at 11:30. Thanks very much for watching.